Hello everybody. At this time we are talking about short-term investments. Short-term investments, also known as marketable securities or temporary investments, are financial investments that can easily be converted to cash, typically within 5 years. Many short-term investments are sold or converted to cash after a period of only 3 to 12 months. Some common examples of short-term investments include money market accounts, high-yield savings accounts, government bonds, and treasury bills. Usually, these investments are high quality and highly liquid assets or investment vehicles. Short-term investments may also refer specifically to financial assets of a similar kind, but with a few additional requirements that are owned by a company, recorded in a separate account, and listed in the current assets. Short-term investments in this context are investments that a company has made that are expected to be converted into cash within 1 year. And then we move to advantages of short-term investing. The first, short-term investing offers flexibility to the investors as they do not need to wait for the security to mature in order to get cash. On the other hand, long-term investments can be liquidated by selling in the secondary market, but the investors earns lower profits. And then second, investors can make substantial profits in a very short amount of time. And then third, it is less risky as money invested per transactions is substantially lower. And then we move to short-term investments goals. Usually, these are several goals to be achieved in most people who choose short-term investments. The most common goal is to raise funds in a short period of time. If you are looking for flexibility, for example, if you need funds for urgent needs in the near future, easy to disburse funds, then short-term investment is the right choice. Another objective of these investments is usually to increase business capital, especially for entrepreneurs who want to expand their business. Then short-term investments can be useful for fresh funds. And then we move to reasons for short-term investing. Short-term investing is driven by some main factors. The first, economic uncertainty. Given the economic uncertainties, investors frequently opt for short-term investments with high returns to avoid prolonged exposure to market volatility. This strategy enables them to protect their capital and respond promptly to economic fluctuations. And second, cash flow management. Companies and individuals engage in short-term investments with high returns to effectively handle cash streams, and these investments grant a balance between preserving capital and earning modest returns, providing ready access to funds when needed. And then we move to characteristics of short-term investments. There are the key characteristics of short-term investment. The first, liquidity. Short-term investments are highly liquid, meaning they can be quickly converted into cash without significant loss of value. And then second, yield correlation with risk. Yields on short-term investments are generally lower compared to longer-term investment, reflecting their lower risk people. And the third, low risk. Short-term investments usually involve lower risk compared to long-term investments because they are less sensitive to market volatility and interest rate changes. And then fourth, about accessibility. Short-term investments are often accessible to individual and institutional investors alike, offering flexibility for various investment needs. And then fifth, short-term horizon. They are intended to be held for less than a year, aligning with short-term financial goals or cash management needs. And then we move to types of short-term investments. When an investor enters the market for short-term investments, there are multiple choices available. There are some of the popular short-term investment instruments. The first, treasury bills. These are financial instruments that are issued and backed by the central government, making them stable investments. Treasury bills are traded in the bond market. The price of these treasury bills is decided through auctions, which usually generate moderate returns. And then we move to the second, equity shares. Many stocks can also provide a good returns in a shorter period of time, but they usually carry higher risk compared to other short-term investments. Depending on your risk appetite, equity shares that are issued by mid-cap or small-cap companies can be considered, as they usually have higher potential for returns but also carry higher risk. And then third, commercial papers. These are unsecured short-term debt instruments raised by companies to meet their short-term financial requirements. Commercial papers rarely come with a maturity of more than 270 days. These are usually not independent of market fluctuations, unlike treasury bills, but they also tend to provide higher yields. And then fourth, certificate of deposit. A certificate of deposit is a financial product that is usually sold by banks, issued against a certain substantial deposit. Certificates of deposit are usually preferred in terms of short-term investments, as they offer stability as well as comparatively higher returns than treasury bills, issued for a period ranging anywhere from 7 days to 1 year. And then we move to difference between long-term and short-term investment. Different types of financial instruments serve different goals and come with distinct risk profiles and return expectations. Short-term investments are typically held for less than 3 years and are chosen for their liquidity and lower risk compared to long-term investment. Short-term investment vehicles include savings accounts, short-term fixed deposit, and liquid mutual funds. These investments generally help safeguard wealth and ensure moderate growth for investors. On the other hand, long-term investments are generally held for several years or decades, offering the potential for higher returns at the cost of higher risk and lower liquidity. Equity shares, real estate, and long-term bonds are popular long-term investment options. This is typically the preferred route for investors aiming for significant wealth accommodation and accumulation for future goals like retirement or children's education. I think it is enough. Thanks for watching.